Believe me when I tell you this. I meet with clients all the time and possible prospects all the time who show me what their advisor is doing for them in the market. And I can tell you, 9 times out of 10, it's almost identical. They're just going with the same cookie cutter stuff that most investors, if they had a little extra time and dedicated time to doing it themselves and doing research, would probably pick the majority of the things that these guys are doing themselves. Coming up, we're going to pull back that curtain and show you some of the dirty secrets that your financial advisor does not want you to know about your account and why you need to start thinking outside the box to making money in this down economy. That's coming up. Hello, everybody, and welcome back to the show. Of course, here what we focus on is being truly diversified. We kind of go through the myths of the stock market or snugly safe approaches like CDs and annuities, kind of give you clarity here on how to make sure that your overall portfolio is truly diversified, ways of making money outside of the usual system, the cookie cutters. And that's what we're going to focus on today, one element here, and that is the idea of a financial advisor, the stock market, how they make money, and how you need to realize that, yes, a lot of the people out there are helping you make money, but you need to understand how they make money and where their true intentions lie, right? At the end of the day, it's about making a profit for them and the people they work for. And we just want to make sure that you're aware of exactly how this works so that you now realize that maybe it's time to take a portion of your money, not all of it, just a portion of your money, and look outside the box of Wall Street and the stock market to start making money there. So today we're going to focus on financial advisors, right? And the way that they make money is called AUM. You probably already know this, assets under management, and then they charge a fee. Let's say it's 1%, right? So if you have $1 million, let's say in an IRA or something that you want to hand over to a financial advisor, they're going to charge you 1%, which is about $10,000 every single year on that $1 million. Now, of course, if it goes up, great, that's their job. Maybe they are making 7, 10, 12% for you, stellar. Of course, that is, proof of performance. They do well for you and they make more money. So if they took your money from 1 million to 1.2 million, instead of making $10,000 off you in that next year, they're making $12,000. But what you have to realize is that most of these people really aren't held accountable for when things go up and down. And we're seeing that right now in the market here in 2025, where the market's not really doing too well. I can't say that every single financial advisor out there has lost money for their clients, but you could look at the tea leaves out there and realize that most likely most, if not several, financial advisors out there are having a hard time in the last, 3 to 6 months talking to their clients, giving them reasons and excuses on why the losses are there. They can blame it on politics or, Capitol Hill. That's, of course, possibility of why things are shaky, with these ideas of tariffs. And there's been a power change at Capitol Hill going from, the Biden administration to Trump. That's, of course, going to cause some shakiness on, in Wall Street and in the stock market. Okay. So, of course, there's going to be the excuses. Here's the point I'm making is that if you had $1 million at the beginning of, 2025 with your advisor, and now it's dropped to, say, $900,000, he's only lost $1,000 on the year from you. Okay. So there's really no accountability on that side for him where he's taking such a massive loss. He just needs you to hang in there long term, no matter what. So if you're making decent money, great. He gets the win. He's treated like a hero. But when it drops, he has excuses and just tells you paper loss, just hang in there. And that's what he hopes you'll do, that you don't fire him and go to the next guy who, by the way, is going to sell you the same idea. So you have to realize this. This is how these guys make money. But the secret there also that they're not telling you is that's not the only fee that you have. There's a lot of hidden fees on Wall Street. For instance, if you're going to be in a mutual fund, you do realize that that mutual fund also charges you fees for every move that you make, right? You're going to have to pay for, what they call expense ratios or things of that nature, where every time you're buying a mutual fund, there's a cost there. And there's a lot of basic hidden costs along the way, and they add up. So it's not just 1%, it's going to be more than that to your account. The way they sell it to you, of course, is this. I kind of talk it like about, say, they're baking a cake. They're in the back of the kitchen baking a cake, and they form that cake, but you never see that actual cake. What happens with these little nickel and dime charges and additional fees is they will take a slice out of that cake, reform the cake, and present it to you out on the dining floor. So you think you're getting the whole cake. What they're doing, though, is taking a sliver out, which then means that you're making less money. Now, I'm all about, capitalism in America. Everyone's got to make a buck, right? Their mutual funds aren't doing what they're doing out of the kindness of their heart. They've got to make money too. And this is all fair. It's just that the average investor doesn't realize this is how it works. And if you're happy with that, that's great. But the problem is that when the market takes a dip, you're not only losing money as far as, how far it went down, you're also getting hit by these additional charges, and you're paying somebody 1% to do the best job for you. So this is where we move on to the second point, which is that when you look at what most of these financial advisors are doing, it's fairly cookie cutter. Believe me when I tell you this. I meet with clients all the time and possible prospects all the time who show me what their advisor is doing for them in the market. And I can tell you, 9 times out of 10, it's almost identical. They're just going with the same cookie cutter stuff that most investors, if they had a little extra time and dedicated time to doing it themselves and doing research, would probably pick the majority of the things that these guys are doing themselves, right? So even though they're, quote, experts, most of what they're offering you is fairly packaged. And it's just to get you to be streamlined along with everybody else. The reason they do this is they don't really want to take too much crazy risks for you based on your tolerance, which is responsible, right? Because if they swing for the fences and miss, you're going to get rid of them and you're going to take a big loss. They also don't want to be so low in their risk tolerance that you're barely making anything and you go, well, I could just be in a CD and make that kind of rate of return. So they try to play a safe approach for you where they make just enough money for you to where you're happy. The problem is that when you have a down year, most likely all of that cookie cutter area is going to get affected, right? We have a down year this year so far. We had a down year just a few years ago. Of course, everybody talks about 2008. And I can't say across the board that everybody lost money in those times. But in these cookie cutter situations, it's fairly realistic to think that a lot of people took a hit that year following this cookie cutter lead. And that's my point. These are supposed to be the experts. They're supposed to be on top of your portfolio all the time. But you got to ask yourself if that you have a financial advisor and you put $1 million with him, which is technically accredited investor, and that's kind of the threshold that they're looking for is somebody who has $1 million plus. Imagine if you're in a financial advisor and you have, a bunch of clients so that you have, $10 million or $20 million AUM. You are nickel and diming all these clients together to get that $10,000 fee for each of them, right? So if you have 10 clients, you're making $100,000. If you have 100 clients, you're making $1 million a year, right? Okay, we cover a lot of content on here, and I'm always asked this important question: where do I start? What is a good first step? Well, if you're looking for a way to diversify your retirement away from market volatility and still get competitive returns, I want you to watch this free on-demand training. In under 30 minutes, I will walk you through the exact strategy that smart and wealthy investors like Warren Buffett have used for decades, and they do it by investing in what's called life settlements. We'll break down how this works, real case studies, and how you can add this market-independent asset class to your portfolio without having to lock it up for 10 to 15 years in some low-performing annuity. You will learn how to build stable, predictable growth and, yes, get true diversification, especially in today's uncertain environment. All you have to do is go to lifeassetllc.com/webinar. Again, that is lifeassetllc.com/webinar, or you can click on the link below here and watch it now. It is completely free, and I think you'll find it will be a game changer on how you think about investing for your retirement. Okay, now let's get back to the show. My question to you is, if you have an advisor and you know that he is making, quote, $10,000 off of you to manage your account a year, if you break that down, say per month, it's about $800, $850 a month. How much time do you honestly think that that advisor is paying attention to the moves in your account on a daily basis? I think you would be naive to think hardly at all. They probably just focus on your account every once in a while. And the easiest way for them to manage that is to make sure that most of the people in their realm have the same situation, because it's easier to manage. They're not going to make it personalized for you. Sure, they'll say it's personalized because it might have slight variation to the next guy, but you'll notice a trend. It's almost always the same highway that they go down with the same funds, the same stocks, right? So all of you are affected, and that allows them to do minimal amount of time focusing on each account because they can make a move for everybody. I'm not against financial advisors. I'm not against the stock market, but you have to realize that in that situation, you're not special. You're just like the other 100 or 500 clients they have. And that shows you that most of their moves are affecting most of their clients. And they'll tell you you're diversified because you have money in the stock market, you have money in mutual funds, ETFs, what have you. But the bottom line at the end of the day is, if there's a down market, most of those things are going to get affected. And that isn't true diversification. True diversification is when you have money across the board in your portfolio, in your nest egg, where the ideas of something like the stock market dropping does not affect a portion of the money that you have invested. So what does that look like? Well, there are three categories that I talk about, and two of them are cookie cutter. Number one is the stock market. We call that the risk bucket because, yes, risk reward. That's probably where you're going to make your highest earnings if you take some risk, and you will get rewarded in those good years. And we've seen 7 out of 10 years in the market, you're going to do fairly well. In the 1990s, it was stellar, right? We've all seen that. But the issue is, it's also where you're going to probably take your greatest risk, right? And that means where you're going to see probably the biggest losses you have in those couple of years in a cycle that doesn't do well. This is why most people are overexposed in the market and have to find an alternative way to make sure that some of their money doesn't just be at the mercy of a shaky market like we're seeing right now. Right? The second area is that people usually try to then shove money into what we call a safe money bucket, which would be things like CDs and annuities. And we will, coming up, focus entirely one episode on the myths of the annuity. I don't mind that product if your mindset is right. The problem is that most people selling it have very little experience. It's very easy to get an insurance license, and they don't even understand what they're selling because they're most likely just looking for a commission. Okay, so we're going to go over that in an upcoming episode. You won't want to miss it, because as you head towards retirement, annuities are shoved down your throat, sometimes from financial advisors and some dinner seminar you went to. So I'm going to cut through that for you coming up. But the idea here also with safe money is that it usually doesn't pace out inflation, and the lockup periods are horrendous, 10, 15 years. So sure, if you want a long-term pension plan, that is a place to go. But you don't want to put too much money over there because it's locked up. So the idea here then is you want to look outside the market, right? Key number one, where you're not influenced by the shakiness of politics or the economy or something like a pandemic. And number two, you want to make sure that it has decent returns. And we talked about this in a previous episode. This is where you got to find outside the box the third bucket. And it usually is about 5 to 10% of your net worth. We're not talking everything. So if I was in front of somebody with $1 million, we'd be talking about $50,000 to $100,000, where our goal would be to double that money, if we can, in the next 10 years without exposure to market risk, and make sure that it has a decent earning potential, right? And that it's not influenced by outside stuff like what's going on Capitol Hill, because in America is what we do. We change regimes often, right? We've just look at the last, 15 years. As far as the power struggle, it's so bipolar. Those are going to affect your outcome and your bottom line as you head into retirement. So this is why you've got to take a portion of your money away where all of this stuff that is an outside force to your daily life, right, to where it will make money. And this is where alternatives come in. And this is something we help people do, right? And coming up in future episodes, we're going to show you exactly how to do that. Our information is in our notes and talks about alternatives and different ways of doing it. And we're going to bring on some experts who live in those worlds, from financial advisors to CPAs to heads of industry in the alternative world, who have been making people double-digit returns a lot of times, following the leads of very wise people like Warren Buffett, where he has seen double-digit returns on putting over $1 billion in assets on the alternative market. And that's what we're going to show you here. So coming up in episodes very soon, we're going to discuss with you the other side, which is why you need to be very wary before you buy an annuity. But here today, the message was, if you're going to stay in the market, that's great. It's a great place to make money. But you also have to realize that the person pitching you ideas does it because it's fairly cookie cutter, wants you to agree with it, because he doesn't have a lot of time to, or her, follow your portfolio all the time. He's just glancing at it on a monthly basis and putting you in with everybody else. It's not boutique, right? And most likely, he may not even be following that advice himself. So you have to realize what is the bottom line for these people who are offering this. And I'm making a blanket statement, and I'm sure there's a lot of great advisors out there, but I have seen a ton of statements. I have seen it where it's almost identical to the last statement I saw. And when you're in a market like this, there will be losses. And then the advisor is going to tell you to stay in, keep your money in. You do need to keep some of your money in, but if you are 80, 90, 100% in the market right now with your retirement, you now need to rethink and get outside the box and find something again that has no stock market risk and can give you competitive returns, something that annuities and insurance products or CDs will not do. And that's what this show is about. It's about being truly diversified.